All right, everybody, welcome back to Chapter 6. We're now going to talk about segmented income statements. Now, there's a lot of slides I'm going to go over to demonstrate this, but I promise you, this is super easy because you already know a contribution margin income statement. So let's go over that now. Sales minus variable cost equals contribution margin minus fixed cost equals NOI. That's the traditional contribution margin income statement. So segment margin just breaks up those fixed costs into traceable and common fixed costs. So the only new thing we really need to learn is sales minus variable cost still equals CM, but then we're going to take out what are called traceable fixed costs. Those are fixed costs that are directly traceable to a division to arrive at segment margin. Then we take out our common fixed costs, the ones that can't be traced, to arrive at NOI. So all we're doing is breaking up these fixed costs in the traditional contribution margin income statement into two categories, traceable and common. That's all. Nothing more beyond that. So what is a segment? Well, a segment is any part or activity of an organization that managers want additional data about. So it could be an individual store, it could be a service center, it could be a particular sales territory like the Northeast or the Southeast or the Midwest. It all depends on what managers want information on to make their decisions. There are two keys to building a segmented income statement. One is what I already mentioned, that we're going to use the contribution margin format. And then the second is also what I've already mentioned. We're going to take our fixed costs and break them up into traceable and common elements. Traceable fixed costs are costs that arise because of the existence of a particular segment, and they would be disappeared over time if the segment is disappeared. So in other words, what I recommend you do is ask yourself this question. Would the fixed cost be eliminated if we eliminate the segment? If your answer is yes, it's a traceable fixed cost. If no, then it's a common fixed cost. So here's some examples of traceable fixed costs. The salary of the Fritos product manager at Pepsi is traceable to the Fritos business segment, because if we get rid of the Fritos business segment, we're going to get rid of the Fritos manager. Likewise, the maintenance cost for the building in which Boeing 747s are assembled is traceable to the fixed costs of the 747 business segment of Boeing. Common fixed costs arise because of the overall operation of the company, and they won't disappear if a segment is eliminated. For example, the salary of the CEO of General Motors is a common fixed cost to various divisions of GM. If you get rid of one of their product lines, you're not going to get rid of the CEO. So this is like organization sustaining costs that we talked about in a previous chapter. You get rid of the segment of the business, you don't get rid of those high-level costs. The salary of heating at a Safeway or Kroger grocery store is a common fixed cost of various departments within the store. If you get rid of the produce department, you don't get rid of the overall heating costs for the store itself. It's important to realize that traceable fixed costs for one segment could be common in another. For example, the landing fee paid to land an airplane at an airport is traceable to a particular flight, but not traceable to like first class, business class, and economy class passengers. Likewise, the store manager's salary for a Five Guys store would be traceable to that Five Guys store, say Five Guys in Dover, but would be a common cost if we were breaking down Five Guys into different divisions based on the product lines like burgers, fries, and shakes. So you really have to ask yourself the fundamental question that I went over a little bit ago, which is, could I eliminate this cost if I eliminate the segment? If yes, it's traceable. If no, it's a common cost with respect to that segment. So the segment margin is computed by subtracting those traceable fixed costs from the contribution margin. And the reason we care about it is it's really the best gauge of the long-run profitability of the segment. It's going to tell us whether this segment can be sustainable in the long term. We don't want to allocate common costs, though companies do this a lot because they got to go somewhere, right? Somebody's got to eat them. But if we allocate common costs, we end up making bad decisions. It may look like one segment is losing money when in fact it actually is contributing to the bottom line of the business. It's only losing money because we're allocating some of the CEO's salary to the division. Whether we have the division or not, the CEO's salary isn't going to change, so it doesn't make sense to do that type of allocation. It's going to result in inappropriate decisions being made. So let's go through a little example to demonstrate these concepts. Weber Inc. has two divisions, a computer and television division. We're going to look a little more closely at the television division's income statement. So here's the contribution margin format for the television division. You can see sales minus variable costs gives us our contribution margin, and then we take out just the traceable fixed costs to arrive at the division margin. Contribution margin, again, is computed by just taking sales minus all variable costs, whether those are variable product costs or period costs, it doesn't matter. We take out all variable costs, and then we take out fixed costs to arrive at the divisional margin. In order to get the division margin, we need to remember it's only the traceable fixed costs that would be included. What this then tells us is that $60,000 is the amount that the television division is contributing to the overall profits of the company. So now if we look at the income statement for a company as a whole, they have a television division and a computer division. So you could see that the television division is contributing $60,000 to the bottom line. The computer division is contributing $40,000. But there are common fixed costs like the CEO's salary that would not get allocated, but are still costs for the business when determining the net operating income for the business as a whole. So you could see that the business is only making $75,000, even though the television and computer division are combined adding $100,000 to the bottom line. And the reason for that difference is those common fixed costs. As we already mentioned, the traceable fixed cost for one segment can become common fixed cost if the company is divided into smaller segments. So let's look at a quick example for Weber. Weber's television division, which is one of the divisions we just looked at, can be broken up into their product lines, regular and big screen. So when we do that, we could see that the $90,000 in fixed costs have to get broken up further. Now, they would have to give us that information. We'd have no way to know this. But the point of this slide is just to make a point that what was once a traceable fixed cost, $90,000 for the television division, was all traceable. Only $80,000 of it is traceable to its various product lines, regular and big screen. $10,000 of it is a common fixed cost for the television division itself. So visualize the 10 grand as, say, the manager of the television division. So his salary is not going to be eliminated if we get rid of regular TVs or big screen TVs. So that's a common fixed cost to just the television division overall. So the point again is that fixed costs can be traceable or common depending on the segment or component of the business you're relating it to.